Imagine pouring, your hard-earned savings into a brand new, fully automated trading system.
Right, the dream scenario.
Exactly. You flip the switch, you're dreaming of passive income, and within 6 short months, every single penny is just gone.
Hmm.
Your account is completely wiped out. And the crazy thing is, that is the devastating reality for a staggering 73% of new automated traders.
It really is a massive, incredibly harsh welcome to the financial markets.
It's brutal. I mean, we're doing a deep dive today into automated trading, and that number just jumped out at me.
It's a brutal statistic, yeah. Because people come into this space captivated by, well, basically the ultimate passive income fantasy.
Right, like waking up, grabbing your phone.
And seeing that a machine made you money while you were fast asleep. You just build it, turn it on, and step away to live your life.
The holy grail of personal finance, honestly.
But that hope shatters very quickly when they actually encounter the real mechanics of live trading without a proper foundation.
Right, but based on the sources we're looking at today, those beginners who fail, they aren't losing their shirts because their core ideas are terrible.
Well, not at all.
And it's not because the market is just inherently rigged against them either. They fail because they make very small but incredibly expensive mistakes.
Mistakes that are, quite honestly, entirely avoidable if you just approach the system with the right framework.
Which is exactly our mission today. We are going to explain the entire process of automated trading simply, like specifically, for a complete beginner in finance.
Which is so needed, I think.
Yeah. We want to give you, the listener, the blueprint to understand how this works under the hood so you can, join the successful minority instead of becoming part of that 73%.
And I'll say the underlying concept is far more accessible than most people assume.
Oh, really?
And
Because I
both.
hear algorithmic trading and my brain goes straight to, advanced calculus.
Oh, for sure. Wall-to-wall computer screens, Wall Street quants in suits, yeah.
Yeah.
But the source material actually provides this brilliant analogy. It compares automated trading to a smart thermostat for your money.
A smart thermostat. Okay, I like that. That paints a really clear picture.
Right. Because when you want to heat your house, you don't stand next to the furnace holding a thermometer, manually flipping a switch every time the room temperature drops a single degree.
No, you'd go crazy. You just set a rule. You program it to say, if the temp drops below 68, turn on the heat.
Exactly. And the machine just monitors the environment 24 hours a day, 7 days a week, and it executes your rule.
So a trading bot operates on that exact same principle, just substituting room temperature for market crisis.
That's it. You define the conditions, and the computer monitors the market endlessly. And it executes trades the literal millisecond those conditions are met.
Wow.
And understanding this is crucial because algorithmic trading is, well, it's no longer a fringe hobby.
No, it's massive now.
The data shows that automated systems now account for up to 73% of all U.S. stock market volume.
Wait, 73%? So almost 3/4 of all buying and selling is just machines talking to machines.
Yeah, exactly. Which fundamentally changes how you have to view the market.
I mean, you're competing against software that doesn't need a coffee break, it doesn't get tired, it doesn't feel fear, and it definitely doesn't get greedy.
And critically, it reacts at speeds that are biologically impossible for a human being to match.
Right.
They are the ultimate disciplined participants. So if you want to set up your own financial thermostat and actually survive in this environment, you have to follow a very strict 4-step life cycle for your bot.
Okay, let's get into the blueprint then. What are the 4 steps?
You cannot skip any of these. They are research, backtest, paper trade, and go live.
Okay, let's walk through those chronologically, starting with research. Now, for a beginner, research sounds like spending months in a library reading economic theory.
It really does sound intimidating.
Yeah.
But the sources frame it much more simply. It just starts with a basic hypothesis.
Like a what-if statement.
Exactly, a what-if statement. The source outlines a classic beginner strategy to illustrate this. It's often called a crossover strategy.
Okay, how does that work?
Well, your hypothesis might just be, what if I program my bot to buy Bitcoin whenever its 10-day moving average crosses above its 30-day moving average?
Okay, let's unpack this for anyone new to market terminology. A moving average is just the average price of an asset over a set number of days, right?
Right. It smooths out the chaotic minute-by-minute price bumps.
Uh-huh.
So you can clearly see the actual trend.
So the 10-day average represents short-term momentum.
Yes, and the 30-day average represents the longer-term trend. The logic is that if the short-term price trend suddenly surges upward and crosses over that long-term trend, it might signal the beginning of a big upward run.
That's your core what if. But wait, if these algorithms are so smart and Wall Street has literal supercomputers, isn't guessing a simple pattern like that a recipe for disaster?
That is a very fair point.
I mean, it feels almost dangerously easy to just invent a rule, punch it in, and hope it prints money.
And that skepticism is exactly what you need, which leads directly into step 2, backtesting.
Ah, the reality check.
Yes, this is your reality check. You never just guess and hope. Backtesting involves taking that specific what-if rule and running it backward through a simulation.
Using historical data, I assume.
Exactly, using 2 to 3 years of historical market data.
So you're basically putting your trading bot into a time machine to see how it would have behaved in the past.
You're asking the software to prove its worth. And the sources stress a really vital point here. You must test your strategy against extreme, violent market conditions.
Not just when the market is doing well.
Right. You need to know how your neat little rule would have performed during, say, the massive market crash of March 2020.
Oh, wow. Yeah. Or maybe the prolonged, agonizing crypto winter of 2018.
Exactly. Because if the bot's logic stubbornly kept buying into a plummeting market without any built-in mechanism to cut its losses,
you would have lost your entire portfolio.
yes. Backtesting exposes the flaws in your logic while you are still playing with simulated monopoly money.
Right, before it's real.
Because if a strategy blows up your simulated account during a historical crisis, it will absolutely blow up your real money during a future crisis.
The market is incredibly efficient at finding the weak points in your logic. But I can hear a massive barrier going up for you listening right now, though.
The tech barrier.
Yeah. We're talking about running complex simulations through historical databases, building automated logic. The anxiety for a beginner is always the coding. If you don't know how to code, are you just permanently locked out of this entire world?
10 years ago, honestly, the answer might have been yes.
Right.
But today, the technological barrier to entry has essentially vanished.
Really? How so?
The sources highlight multiple solutions tailored to every skill level.
Right.
Like if you want to learn light trader-specific coding, there are platforms like TradingView.
Oh, I've heard of them.
Yeah, they use a language called PineScript. And MetaTrader uses something called MQL5.
Are those hard to learn?
Not at all. They aren't complex software engineering languages. They are streamlined codes built specifically to interact with financial charts, which makes backtesting incredibly fast.
Okay, but what about the absolute beginner who wants a zero coding option? Like they don't want to type a single line of script. How do they participate?
The doors are wide open there as well. You have platforms like Build Alpha, which function as visual builders.
Visual builders like drag and drop.
Exactly. You simply drag and drop different signals and rules onto your screen, snapping them together like digital building blocks.
Oh, that's cool.
And furthermore, we are entering the era of artificial intelligence assistants. The sources specifically point to AI agents like Claude Cowork.
Wow, so the AI gets involved.
Yeah, you can describe your trading strategy in plain English, and the AI will literally write the code for you.
That is wild. It just translates your English into the bot's language.
It translates it, it scans your previous trade history to analyze patterns, and it can even connect directly to your exchange's API.
Okay, let's clarify what an API is for a beginner, because it definitely sounds intimidating.
It does, yeah.
Think of an API, an application programming interface, like a digital waiter at a restaurant.
I love this analogy.
Right. Your bot is sitting at the table, and it decides it wants to order a stock. It can't just walk into the kitchen and grab it.
Yeah, they kick you out.
Exactly. It hands the order to the waiter, the API, who securely carries that request to the exchange, which is the kitchen. The kitchen prepares the stock, hands it to the waiter, and the waiter delivers it back to your bot.
That's exactly it. And the AI tools today basically hire and train that waiter for you.
That is incredibly reassuring. So
Yeah.
the technical execution is solved, which means we can move to step 3.
Yes.
The bot is built, we ran it through the time machine of backtesting, and the results look beautiful. Logic dictates that you are now ready to go live and start trading real money.
Logic would dictate that.
Yeah.
But jumping from backtesting straight to live money is precisely where so many beginners fall into that 73% failure rate.
Ah, so there's a trap.
A huge one. You cannot skip step 3, paper trading.
Why do we need another simulation, though? If the backtest proved the math works over the last 3 years, shouldn't that be enough?
Because backtesting only proves that your strategy worked in the past.
Okay.
Paper trading proves whether it works in the present.
Oh, I see.
Paper trading means connecting your fully built bot to live real-time market data. but having it execute trades using fake money.
So it's a forward-looking simulation?
Yes. You let it run for a few weeks to see how it reacts to today's news cycle, today's market volume, and today's volatility. It's basically the final dress rehearsal.
That makes total sense. You're making sure the machine didn't just, memorize the answers to the historical test, but can actually adapt to new information. So once you pass the paper trading phase, we arrive at step 4, go live, you finally fund the account. But this is where the sources throw a massive curveball.
Yeah, this is the biggest secret in the industry, and it's the key insight that separates seasoned professionals from the absolute victims.
Okay, Leonas.
Automated trading is only 10% strategy. The other 90% is risk management.
Wait, what? If my backtest and my paper trading perfectly predicted the market 90% of the time, why on earth would I fail in the real world?
Because simulations assume a frictionless universe. They assume perfect execution.
And the real market is messy.
Incredibly messy. The primary invisible enemy you face out there is a concept known as slippage.
Slippage. Let me make sure the mechanics of this are clear. Slippage is the painful financial difference between the price you want to pay and the price you actually get. So my bot decides to buy a specific stock right now at exactly $100. It hands that order to our digital waiter, the API. But because the market is a global auction moving at lightning speed, by the time the order actually reaches the exchange, like a fraction of a second later, the price has jumped to $100.50.
Yep, the price moved.
The bot buys it at the new, worse price. That 50 cents is the slippage.
And in a fast-moving, volatile market, that slippage can be massive. Add to that the inevitable technical glitches, your internet connection stutters, the exchange's servers bog down during high volume,
Right.
or maybe the API experiences a split-second delay. Suddenly, a strategy that looked like a guaranteed flawless winner on paper is bleeding money from 1,000 tiny cuts in reality.
But wait, if the algorithmic bots are doing 73% of all trading and they process info in milliseconds, why can't they just predict the slippage?
You'd think they could, right?
Yeah, why can't the bot calculate the network delay and adjust its bid accordingly?
Because you are dealing with market liquidity, which is just human chaos translated into numbers.
Human chaos. I love that.
You cannot predict exactly how many other traders are trying to buy that exact same asset at that exact same millisecond.
Oh, right. Like, if a massive hedge fund dumps a huge order right as your bot tries to buy.
The available supply instantly vanishes, and the price spikes before your order fills. The bot can't see the future. It can only react to the present data feed.
I'm picturing this entire scenario like someone who built a high-performance race car.
Okay.
The backtesting and paper trading phases, that's like them driving that car on an empty, perfectly paved test track. Everything handles flawlessly.
Good, actually.
But going live without understanding slippage is like taking that same car and driving it onto a busy highway during rush hour.
That is a perfect analogy.
You aren't accounting for real-world traffic, erratic drivers, sudden potholes. If you keep your foot slammed on the gas, you are going to crash.
And keeping your foot slammed on the gas pedal is what the financial world calls improper position sizing.
Improper position sizing.
Beginners get incredibly arrogant because their backtests look so profitable. So they go live and risk huge chunks of their total account on every single trade, thinking it's a sure thing.
Oh, no.
Yeah. When the real-world slippage hits, combined with the inevitable losing streaks that all systems face, their account is instantly destroyed.
So you can't cure slippage, you just have to minimize your exposure to it. How do the professionals build a better gas pedal?
They follow strict, unemotional rules, specifically the 2% rule.
The 2% rule.
A professional algorithmic trader will never, under any circumstances, risk more than 2% of their total account balance on a single trade.
Wow, that's small.
It is. But for the beginner listening right now, the source's recommendation is even tighter. You should be aiming at 0.5% to 1% risk per trade.
Let's do the math on that to really cement it. If you have a total trading account of $10,000, a 1% risk means you are never putting more than $100 in jeopardy on any given trade.
Exactly. That $100 is your absolute maximum potential loss if the trade goes completely wrong and the market tanks.
It's like installing massive protective speed bumps into your system.
Yes. Because even if your bot hits a catastrophic losing streak, say 10 bad trades in a row due to crazy market conditions and severe slippage, you're only down 10% of your total account.
You survive to trade another day.
Exactly. Meanwhile, the amateur who is risking 20% per trade is entirely wiped out and permanently removed from the game. Survival trumps strategy every single time.
You have to wear your armor. Okay, so we've talked about building the bot through the four-step cycle. We've talked about installing these risk management speed bumps to survive slippage.
Essential foundations, yeah.
But even after doing all of that perfectly, we arrive at the final hurdle. And it is a fascinating paradox.
The human element.
Yes, because even though this entire system is 100% automated, the biggest threat to your portfolio is still you, the human being.
It really is the ultimate irony of automation. The sources provide a devastating metric here. Psychological interference leads to an average loss of 68% for automated traders.
69%.
Think about the gravity of that. The machine is running fine, executing the math perfectly, but the human jumps in and actively causes a massive loss.
But how? How does someone sabotage a machine they program themselves? You spent weeks backtesting and paper trading. Why would you suddenly intervene?
To understand that, we have to look at behavioral economics, specifically a concept called loss aversion.
Okay, loss aversion.
Human beings are fundamentally emotional creatures, and money triggers our deepest survival instincts. Psychological studies consistently show that the pain of losing $100 feels twice as intense as the joy of winning $100.
Oh, wow. So when we see red on the screen, our brain literally registers it as a physical threat, like cortisol floods the system.
Exactly that. Let's trace the emotional cycle of a beginner. You turn the bot on with live money. It takes its first trade, and it loses.
You feel a ping of anxiety.
Right. It takes a second trade, and it loses again. Now your heart rate is elevating.
Sweating a little bit.
Yeah. By the third losing trade, loss aversion triggers full-blown panic. You look at the chart, the cortisol takes over, and your brain screams, the bot is broken, the market has changed, I have to stop the bleeding.
So you panic and you manually override the system.
Yes.
You hit the emergency stop button, or worse, you go into the software settings and start tweaking the rules right in the middle of a live, volatile market session.
And the moment you do that, you have destroyed the entire foundation of the system.
Because it's no longer the system you tested.
Exactly. You've taken a disciplined, thoroughly back-tested mathematical approach and instantly downgraded it back into emotional gambling.
You second-guessed the very logic that you spent hours verifying during the research and paper trading phases, just because you couldn't handle the temporary discomfort of a standard losing streak.
Which is deeply human. We want to take control when we feel threatened.
But what you're really highlighting here is that the true superpower of an automated trading system isn't really its execution speed or its ability to handle complex math.
No, it's not.
Its real superpower is completely removing you, the flawed, emotional human, from the equation.
It enforces discipline when your own discipline fails. And by removing the human bottleneck, it expands your capabilities far beyond biological limits.
Right, because it can do things we just physically can't.
The sources highlight that a well-built system can seamlessly monitor 460 different cryptocurrencies or scan multiple global stock markets simultaneously, checking hundreds of conditions every single second.
You literally cannot do that with a human brain. If you try to watch 400 charts at once, your eyes will glaze over and you will miss the crucial signals.
The machine scales your logic infinitely, and it executes without hesitation or fear. But to let it do its job, you have to undergo a massive psychological shift.
What kind of shift?
You have to reframe your expectations entirely. The amateur views automated trading as a casino slot machine. They're lured in by social media influencers and start chasing outrageous, like 100% monthly gains.
Which mathematically requires risking so much of your account on a single trade that you violate the 1% rule, meaning a string of losses will eventually blow up the account anyway.
Exactly. The professional, however, treats their automated trading bot like a deeply boring, incredibly stable business.
Boring is good in finance.
Boring is great. Your goal shouldn't be to double your money every month. Your goal should be targeting realistic, sustainable annual returns, perhaps in the range of 15 to 25%.
That might sound low to a beginner hyped up on the fantasy of overnight riches.
Sure.
But compounding 20% consistently year after year, letting the math do the heavy lifting, is the true path to long-term wealth.
It absolutely is.
Let's pull all of these threads together. We started with the ultimate financial dream of making money in your sleep, and we found out that the reality requires a much stronger framework. Automated trading is fundamentally not a get-rich-quick scheme.
Not at all.
It is, at its core, a tool for extreme discipline.
It forces you to define your rules clearly, test your assumptions against historical data, paper trade in the present, and manage your risks with cold, hard numbers before you ever put a single real dollar on the line.
And the sources have a very clear, direct piece of actionable advice for anyone listening who wants to start exploring this space.
I think this is the most important takeaway.
Do not go live with real money today.
Please don't.
Follow the blueprint. Open a demo account, use fake money with real-time data, and pick a very simple, understandable strategy like that moving average crossover we broke down earlier.
Test it, watch it run.
Watch it win, and more importantly, watch it lose, until you intimately understand its strengths and its weaknesses.
Because that repetitive observation is the only way to build the psychological trust necessary to actually leave the bot alone when it inevitably experiences a losing streak.
You have to transition from trading with your heart to trading with a system.
Stop reacting. Start systemizing.
I love that. Stop reacting, start systemizing. So as we wrap up this deep dive into the mechanics of automated trading, I want to leave you with one final, lingering question to ponder on your own.
Oh, this is a good one.
We've established that the ultimate superpower of these bots is completely removing human emotion from the decision-making process. But what about the rest of your life? If you look at your broader personal finances, your monthly budgeting, your savings rate, your impulsive spending habits, where else could you mentally install an algorithm to protect you from your own worst emotional habits? Until next time, keep exploring.